Hello my dear investors, the Japanese index Nikkei 225 is trading at an all-time high and has even outperformed the S&P 500 with heavyweights such as Apple, Microsoft, Tesla and others over the past 10 years. But it gets even better because while numerous US stocks are valued as historically far above or with much higher price earnings ratios than within the last 10 years, many Japanese stocks are still cheap. In this video, I introduce you to a quality Japanese dividend stock in the IT healthcare sector that I believe is a nice buy. My name is Thorsten. I'm the founder of Dividend Stocks Cash. We have more than 110,000 members looking for high quality stocks to profit from long-term sustainable capital gains and dividend growth as well. So, before I continue, please take care of your own money. This is no buy recommendation. Please make due diligence yourself before pressing the buy button. This is the Nikkei 225 in blue area chart, and this is the performance of the S&P 500 in orange within the last 10, even 12 years, and you can see here the outperformance. When we go to the screener, we have all stocks of the Nikkei 225 and even some more. You can see it here if we filter by country, Japan. And now it gets interesting. Let's sort by quality stocks. Quality stocks first. Here I do it by clicking here on quality stocks, and here we see quality stocks. And now we have here dynamic dividend growth between 10, 20, 30% on average within the last 10 or 5 years. We have solid dividend payers. Most of them pay dividends twice a year. We have stable earnings growth, and it's also very interesting here the multiples price earnings ratio on reported price earnings ratio and adjusted earnings price to cash flow price to sales. And these ratios or multiples are much lower compared to many Western hyped stocks. And here we see the valuation, indication of the valuation. We use here the average 10 years multiples, this area, and we calculate the fair value based on this by comparing the current multiple with the average multiple of the last 10 years. And always, if the number is negative, indicated in green, then the stock seems to be undervalued. The stock is undervalued because the stock is valued with lower multiples than in the past 10 years on average. Okay, and then we see here that although the stocks seem to be cheap, we have here nice capital gains on the long run, even some Tenbaggers and multi-Tenbaggers if you just invested into these stocks long enough. And what I'm analyzing now is a stock not called 3M. This is 3M, is still pre-selected. No, it is M3. No joke, this is M3, and M3 is in the IT healthcare business. And you know that we have this mega trend in IT healthcare in the industrial or in developed nations. Healthcare gets more accessible, you can do more, you can heal more diseases, treat better, but all this costs money. And this puts pressure on the expense, on the budget, of the financial budget of states, governments. And how can you heal this financial pressure? By making the healthcare system more efficient. And how do you make systems more efficient? With IT, and this is what M3 is doing. They have different segments here, but first I want to show you the fundamentals. You see here long-term earnings growth, long-term dividend growth. They increased dividends for 15 years already, and there is no end in sight, with dividend increase rates in the past of around 20% annually. And here you see a little peak in the earnings and now a consolidation. And this peak in earnings is because they sold, how is it said? They sold part of the company here. And this is why the net margin increased dramatically and was nearly as high as the operating margin. You can also see here in profit loss calculation of 22, there's a non-operating income which added to the total income, and this is why we have here this very high, this peak in reported earnings. And additionally, they profited, the M3 company profited from Corona. You can see it here in their most recent presentation. This was additional Corona-driven revenue, and now this additional Corona-driven revenue goes down, but it's compensated by organic revenue growth. You can see this here. So there is no need to worry about the business itself. We have very solid balance sheet. We have here, for example, if I compare interest-bearing debt with cash position, you see that the company is debt-free, basically. So very solid balance sheet. We have some goodwill because the company acquires our companies, but this is how it grows and how it goes for more than 10 years already, as you can see by choosing the goodwill. What is M3 doing? Let's have a look at the segments. Then we have different segments. We have, for example, medical platform. This is a platform. We have more than 320,000 doctors registered there. What can they do? They can administer their documents of their patients. You can consult them using this platform as a patient. It's telemedicine in German. You have education, you can do as a doctor there. And of course, it serves as marketing channel for pharma companies. They can make start campaigns for drugs and so on, and they can target easily the kind right of doctors using this platform. So this is medical platform, and it is responsible for close to 40% of total revenue. Then let's continue with site solutions. This is software, IT solutions for the running business of hospitals, pharmacies, and where the doctors are operating, if they have their own business, for example. And they can create invoices by this, or they can plan the appointments with patients and so on. Then we have evidence solution. This is this one. Evidence solution. They assist with clinical trials, for example, to find persons willing to do these trials. We have career solution here, which is basically a job portal for doctors and pharmacists, for example. And we have here the will to create new businesses and other emerging businesses, which is 1.4% of total sales. And then we have overseas, which is very interesting, because this company is not only successful in Japanese heartland or core land, but they also make around 27% of revenues outside Japan. Here you see it. They have 73% of revenues in Japan, and then also in North America, Europe, and other countries. And you can see that the revenue growth outside Japan is dynamic as well. So it's a very promising company in my point of view. And now let's check the performance, the capital gains or losses. And you can see here that we have tremendous capital losses since 21, beginning of 21 here. The stock lost about close to 80 or around 80%. And this is tremendous or really high. But anyway, if in the last 10 years, if you invested, although there's a strong correction, you can see it here, then we have still capital gains of around 250%. And if you just go back long enough to where it all started, this is in 2004, it is here, then we have more than 2 times Tenbagger. And now the question is, why did the stock price drop that dramatically within the last years? And I haven't found any specific problem of the company itself, but in my point of view, the main problem was dramatic overvaluation of the stock with price earnings close to 200 when the stock reaches all-time high here. And we see here that in the past the stock was valued around the 70, 60, 70 price earnings, and now price earnings is around 30. So much cheaper, the stock got much cheaper than in the past, and especially here when it was obviously completely overhyped and overvalued. So this is, to me, seems to be the main reason why the stock needed a correction, and this now might be a nice buying opportunity. Let's calculate the fair value of the stock, and you see here the evolution of the stock price. Again, we can use the reported earnings, we could also use the adjusted earnings, which are nearly identical. We can also use the operating cash flow for valuation, for example. We will use both, and if I just use the default settings of fair value calculation, I get this. Default settings means we use the 10 years average valuation of the stock to calculate the fair value, and here are applied fair multiples of around 66 or 65 for both price earnings and price to cash flow, but we need to adjust this. Here the fair value would be around 5 to 5.6 Japanese yen for the current business year, running current business year, ending in March this year. But we have here in the past higher earnings and operating cash flow growth with somewhere around 20 up to 25%, and here we have earnings growth at estimated earnings growth of about 11, 12, 30% maybe. So we have a slowdown of earnings growth, and so we need to bring the multiples lower, dramatically lower in my point of view, to have a more conservative and more realistic approach to know what capital gains to expect. We will do this by adding a much lower number here for the price earnings. I adjust from 66 to 30. I more than half them, and then you see here the new fair value, and I do the same for the price to cash flow. I adjust it to 30, and now we see here that the fair value is much lower than it was in the past. So in the past it was much valued with much higher multiples. We've seen it here. And now we zoom in a little bit more, and now we can calculate a more conservative approach, what to expect if we buy the stock right now. This is the current stock price. I choose the lower of the two fair values in 27, and this is the expected annual yield of close to 12%. With our words, we downgraded the fair value a lot, and we still have an expected annual yield of close to 12%, which means outperformance with a solid business model. And this is why I think that this stock is really interesting. And if you are looking for stocks outside the US, dividend paying stocks as well, excuse me, I forgot to introduce you to M3 as dividend payer. Here I do it, and here this is the evolution of the dividend, and you see here we have a micro dividend yield of less than 0.1%, but you see that it rose considerably because the stock price dropped, and now it's 1.8%, and here you have dynamic dividend growth, so you see that the dividend yield based on your costs of here goes up to 1.3% at the end of April 27. So in other words, most of the return to expect from the stocks comes from capital gains, but if you keep this stock in your portfolio long enough, then you will also be happy about dynamically rising, growing dividends as well. So this was M3, a stock you will see covered nowhere else except on Dividend Stocks Cash. We have more, or around 300 stocks here of Japan analyzed, the Nikkei 225 complete, and then our stocks we deem to be interesting and worth to be added to our screener. Thanks for watching. Please drop a comment below what you think about the stocks. Do you want to see some more analysis of Japanese stocks? You can comment this as well. See you next video. Bye bye.